So we just went through an indirect method cash flow statement example. And the next thing I want to talk about is why can we make the indirect method when making it? Or in other words, when you are making it, does it ever occur to you that why? So we start from the net income here. And then we take all of the change in the balance sheet account. And then boom, it will give you the change in the firm's cash account. So why? Why can we start from net income and then we adjust for all of the change in balance sheet item? And then magically, it will give you the change in the firm's cash account. Please spend 5 minutes, try to think about it on your own, and you can pause your video for now. So why? If you think about the universe of all of the journal entries we can only make 7 kinds of journal entries. The first kind is that you debit cash, credit an income statement account, or you debit an income statement account and credit cash, or you debit cash and credit a balance sheet non-cash account, or you debit a balance sheet non-cash account and credit cash, or you debit an income statement account, credit a balance sheet non-cash account, or you debit a balance sheet non-cash account and credit an income statement account. And then the last one is that you debit a balance sheet non-cash account and credit a balance sheet non-cash account. So here we're just supposing here there's no transaction 7. So there's no transaction that involves debit a balance sheet non-cash account and credit another balance sheet non-cash account. If there's any such transaction, it needs to be separately disclosed in your 10K report. But let's just suppose here there's no transaction 7. So suppose we only have the previous this 1 to 6, those kind of transactions. And if you think about net income, what is net income made up of? Net income is actually made up of your transaction 1, transaction 2. So those 2 transactions involve net income, involve income statement accounts, and then transaction 5 and transaction 6. And then what is your change in cash? So change in cash is the sum of all of the debits and credits in your cash account, right? So that's the sum of your transaction 1, 2, 3, and 4. So we start from, it's like we're giving net income. So it's like we're starting from the sum of transactions 1, 2, 5, and 6. And we want to get to transactions 1, 2, and 3, 4. What should we do? So we need to take out 5, take out 6, plus 3, plus 4, right? So those are actually all of your non-balance sheet. So that is the change in your balance sheet non-cash account. So this is why.